Hi Doctor, we are from Group 2. We are going to start our financial accounting assignment presentation about comparison of ratio between Matrix Concept Holdings Berhad and Ivory Property Group Berhad. I am Lam Kayan as leader of Group 2, and we have Chin Zhenjia, Lai Li En, Mak Kawin, and Tan Kai Li as our member.
My name is Lai Li En. Now, I would like to share insight into two leading Malaysian property development companies, which is Matrix Concept Holdings Berhad and Ivory Properties Group Berhad. These organizations have made significant contributions to the property and real estate landscape in Malaysia, each with distinct focuses and achievements. Matrix Concept Holdings Berhad was incorporated in 1999 and was listed on the main board of Bursa Malaysia Securities Berhad on May 28, 2013. The principal business activity focused on four main pillars, which is property development, construction, education, and hospitality. The company was founded by Tian Hock Lee on December 24, 1999, and is headquartered in Seremban, Malaysia. Matrix was developing two township developments, Bandar Seri Sendayan in Seremban, Negeri Sembilan, and Bandar Seri Impian di Kurang Johor. Matrix's commitment to excellence is reflected in its accolades, such as Forbes Asia 200 Best Under a Million. The company embodies the tagline, nurturing environment, enriching life, emphasizing community-centric development and high-quality living standards. Next, Ivory Property Group Berhad was founded by Eng Hock Loh on June 30, 1999, and is headquartered in Georgetown, Malaysia. Its segments include property development and management, construction contracts, investment holding, and others. Ivory Properties is known for its focus on premium high-rise residential and mixed-use developments. Iconic projects like Penang Times Square, the View Twin Tower, and Moonlight Bay highlight its reputation for creating vibrant urban lifestyle. Ivory prioritizes customer-centric designs and innovation, enhancing quality of life through unique and timeless spaces. Both companies showcase the diversity and innovation of Malaysia's property development industry. Matrix Concept is recognized for its large-scale, sustainable township and global ambitions, while Ivory Properties specializes in creating iconic, urban-centric developments. They represent the evolving landscape of modern living in Malaysia, shaping how communities live, work, and grow.
Now, I will talk about ratio analysis. First of all is liquidity ratio. A liquidity ratio is a measurement which is used to indicate whether a debtor will be able to pay their short-term debt off with the cash they have readily available or whether they will need to raise additional capital to cover the amount. Which is current ratio. The current ratio is a liquidity ratio that measures a company's ability to pay short-term obligation or those due within 1 year. As you can see on the table, Matrix Concept current ratio of 1.121 means that for every ringgit of current liability, it has 2 ringgit 21 cent in current asset. This indicates a strong liquidity position, suggesting that Matrix Concept can easily cover its short-term obligation. Ivory Property current ratio of 0.56 means that for every ringgit of current liability, it has only 56 cents in current assets. This indicates a weaker liquidity position, suggesting that Ivory Property might struggle to meet its short-term obligation. This graph is showing about comparison of current ratio between Matrix Concept and Ivory Property. Next, another liquidity ratio is quick ratio. Quick ratio is a calculation that measures a company's ability to meet its short-term obligation with its most liquid asset. As you can see in the table, Matrix Concept ratio of 1.59 indicated that for every ringgit of current liability, Matrix Concept have 1 ringgit 59 cent in liquid asset. A quick ratio above 1 typically suggests that Matrix can comfortably cover its short-term liabilities without relying on the sales of inventory. This indicated strong liquidity and financial health. Ivory Property quick ratio of 0.36 indicates that Ivory Property has only 37 cents in liquid asset for every ringgit of current liability. A quick ratio between 1 indicates that Ivory may struggle to meet its short-term liability without selling inventory or seeking additional financing. This suggests weaker liquidity and potential financial instability. This graph is showing about comparison of quick ratio between Matrix Concept and Ivory Property. Next ratio is about activity ratio. An activity ratio is a type of financial metrics that indicates how efficiently a company is leveraging the asset on its balance sheet to generate revenue and cash. One of the activity ratio is total asset turnover. Total asset turnover measures that the value of a company's sales or revenue relative to the value of its asset. As you can see in the table, Matrix Concept total asset turnover is 0.42 times. This means Matrix Concept generates 42 cents in sales for every ringgit of asset. A ratio of 0.42 indicates moderate efficiency in using asset to generate revenue. While it shows that the company is generating sales for its asset, there is room for improvement to optimize asset utilization. Ivory Property total asset turnover is negative 0.03 times. A negative turnover ratio suggests that Ivory Property is incurring loss or has minimal sales relative to its total asset. This indicates very poor efficiency and potentially significant financial difficulties. A negative ratio typically reflects that the company is not effectively using its asset to generate revenue, possible due to operation issue or low market demand. This graph is showing about comparison of total asset turnover between Matrix Concept and Ivory Property. Another activity ratio is account receivable turnover. Account receivable turnover ratio measures the number of times a company collects its average account receivable balance. As you can see in the table, Matrix Concept account receivable turnover is 0.9 times. This shows that Matrix Concept collect receivable amount once a year, resulting in an annual turns rate of 0.9. Although no particular height, it shows that the company does collect its receivable within a reasonable time frame. However, there is still room for improvement in increasing cash flow and reducing outstanding receivable. The account receivable turnover from Ivory property is negative 0.36 times. A negative turnover rate of account receivable indicates that the Ivory property has not effectively collected its account receivable. This indicates that the company is facing a major problem of overdue account receivable or possible cancellations. This negative ratio is a serious red flag, highlighting potential problems with credit policy, customer repayment ability, or overall financial health. This graph is showing about comparison of account receivable turnover between Matrix Concept and Ivory property.
Now I'm continue to present about 2.3 probability review. So probability reviews are a class of financial metrics that used to assess a business ability to generate earnings relative to its revenue, operating costs, balance sheet assets, or shareholders' equity over time. In probability review have two subtitles, which is profit margin on sales and return on common shareholders' equity. For profit margin on sales, it means to which a company or a particular business activity makes money. And for return on common shareholders' equity, it means how much money common shareholders receive from a company compared with how much they invest originally. This is profit margin on sales for these two companies, which is Matrix Concept and average probabilities. So as a result, Matrix Concept record 0.4391% and average probability record 1.9136% for profit margin on sales. And this graph is showing the company's profit margin on sales in 2023. Ivory has a profit margin on sales of 1.9136 and Matrix is 0.4391, which might be considered favorable. And this is financial metrics that represent the percentage of profit a company makes from its total revenue. So next is about return on common shareholders' equity. So as a result, return on a common shareholder equity for Matrix Concept is 0.2498% and hourly probabilities is 0.2287%. This graph is showing the company's returns on common shareholders' equity in 2023. Matrix has a return common shareholder equity of 0.2498 and for Ivory is 0.2287, which indicates that every ringgit of common shareholders' equity, the company generates a profit of approximately 0.2498 ringgit and 0.2287 ringgit. Next is about 2.4 leverage ratio, and it means type of financial measurement used in finance, business, and economics to evaluate the level of debt relative to another financial metrics. In this ratio, have two types of ratio, which is debt to assets ratio and debt to equity ratio. For debt to assets ratio, it means that the debt ratio or debt to asset ratio is calculated by dividing a company's total debt by its total assets. For debt to equity ratio, it means a financial metrics that measures a proportion for a company's debt relative to its shareholder equity. This is the debt of assets ratio, and Matrix Concept record about 0.2466% and Ivory property record about 0.278003% for debt to asset ratio. This graph is showing that the debts to asset ratio in 2023 with these two companies, Ivory has debt to asset ratio of 0.287803 and Matrix is 0.2466, which seems that the company has a moderate level of financial leverage. Last but not least is debt to equity ratio. Matrix Concept record 0.4391% and Ivory Properties record about 1.4348% for debt to equity ratio. The following graph of company's debt to equity ratio in 2023, Ivory has a debt to equity ratio of 1.4348 and Matrix is 0.4391, which seems like the company has a moderate level of financial leverage with debt accounting for a size portion for its capital structure.
Next, comparison of ratio between companies, that is, Matrix Concept Holding Berhad and Ivory Property Group Berhad. Can see the difference in the liquidity ratio, activity ratio, profitability ratio, and leverage ratio. In the liquidity ratio comparison, Matrix shows the strong finance health with a current ratio of 2.21, covering its short-term liabilities more than twice. Conversely, Ivory's current ratio of 0.56 indicates it has more liabilities than assets, posting repayment risk. For the quick ratio, Matrix 1.59 shows sufficient liquid asset to manage short-term obligations without relative on inventory, while Ivory's 0.37 highlights important liquidity risk, lacking enough liquid asset for debt coverage. Activity ratio comparison show Matrix at debt risk
efficient asset utilization with a total asset turnover ratio of 0.42, generating RM 0.42 for every RM1 of asset. Ivory with a negative ratio of negative 0.03 reflect poor asset uses and potential losses. In account receivable turnover matrix 0.90 indicates slow collection but is far better than Ivory's negative 0.36, which point to serious revenue and receivable management challenges. Profitability ratio comparison show metric reports strong profitability with a 43.91% profit margin, driven by operational efficiency, while Ivory's 191.36% margin suggests unsustainable one-off income sources in return on equity. Metric list with 24.98% showing a fatter shareholder fund utilization compared to Ivory's slightly lower but respectable 22.87%. In the leverage ratio comparison matrix, asset to debt ratio of 24.66% signal high leverage, while Ivory's 78.03% reflect a comparatively better asset to debt balance. Metric also maintain a healthier capital structure with a debt to equity ratio of 0.4391, constructing Ivory's 1.4348, which indicates high debt reliance and increased financial risk.
Good day, Professor. Now I will talk about how Metric Concept Holdings Berhad and Ivory Properties Group Berhad can improve their current performance. Let's start with Metric Concept Holding Berhad. To improve liquidity, Metric Concept should enhance cash flow forecasting to better match inflow with outflow, manage inventory more efficiently to reduce holding costs, and also invest extra cash reserved in short-term financial instruments for better returns without sacrificing liquidity. For better asset utilization, the company can repurpose or sell unused assets to improve efficiency. Additionally, strengthening marketing and sales strategies will drive revenue growth. Leveraging advanced technology like data analytics can further identify inefficiencies and optimize resource allocation. Finally, to boost profitability, operational costs must be reduced. This could include renegotiating supplier contracts and automating routine tasks. Expanding into new markets and introducing high-margin products will also diversify income streams and enhance profitability. Let's look at Ivory Properties Group Berhad. To address liquidity problems, Ivory Properties should accelerate accounts receivable collections by offering early payment discount and tightening credit policies. Negotiating longer payment terms with suppliers to preserve cash flow. Consider short-term financing options like bridging loan to address immediate cash needs. To improve operational efficiency, the company should focus on speeding up project completion to generate revenue sooner. Implementing a proper project management system will help control cost and timeliness. Additionally, increased marketing efforts can attract more buyers and improve sales. Finally, to reduce financial leverage, the company should restructure its debts and negotiate repayment terms with creditors. Issuing shares for equity could provide alternative funding while reducing reliance on debt. At the same time, cutting unnecessary expenses and improving cost efficiency will help generate free cash flow for debt repayment. In conclusion, both companies exhibit strengths but also face key challenges that need to be addressed. For Metric Concept Holding Berhad, the focus should be on improving liquidity, utilizing assets more effectively, and enhancing profitability. For Ivory Properties Group Berhad, addressing liquidity issues, improving operational efficiency, and reducing financial leverage are critical steps. By implementing these suggestions, both companies can achieve better financial health and long-term growth. That's all for us. Thank you.